Welcome to the fourth and final webcast in Merchant Link's Payments Education series. I'm Beth McGarity, Marketing Manager, and with me in the newsroom is Zachary Minton, Manager of Learning and Development. In our last installment, we examined interchange fee guidelines and how those fees may vary by transaction. In today's webcast, we'll take a few minutes to look at merchant services, pricing, and what you can do to better manage your processing costs.
As we've learned in previous webcasts, merchants of all types have a better chance of managing payments costs by staying informed of how their transactions flow through the network and how each of the players determine the price of each transaction. Likewise, merchants that follow best practices for accepting payments and who settle their batches more routinely are likely to save on unnecessary processing costs. We can't control what type of card a customer uses to make a payment, nor can we control the fact that card transactions for certain types of businesses are simply riskier. But we can control how we operate and what we pay for various services. It can mean the difference in hundreds or even thousands of dollars in savings at the end of the year. Merchants looking for ways to lower processing costs should examine their existing merchant services agreement, renegotiate the fees they're paying based on their transaction trends, and utilize the latest technology to secure transactions. Preventing downgrades, reducing chargebacks and disputes, and avoiding fines for mishandling cardholder data need to become a part of their daily business. New merchants looking for the lowest processing fees need to anticipate the type of transactions they expect at their business before they consider the pricing options available. The more they understand about standard processing costs and the more they follow the best practices suggested by payments industry experts, the better chance they have at keeping their processing cost as low as possible.
Well, joining us now via live satellite feed is a merchant with Tom's Diner in Phoenix, Arizona. Roger, thank you for joining us. What questions do you have for us today about your credit card payments?
Thanks for having me, Beth and Zach. Well, business has been going very well for us lately, and we're processing so many more types of card transactions than we used to. As a result, we continue to closely monitor our processing costs, which are bundled into a tiered pricing model. Over the past year, we've noticed a significant increase in downgrades and higher fees on a number of transactions. What can we do to better manage this and lower our processing costs?
Roger, there are a few things you can consider right away. For example, are any of the transactions that are downgrading occurring because of things within your control, such as a manually entered card number versus a swipe?
Well, it's kind of hard to tell without researching every single transaction. But I do know that my employees get a swipe when possible. We follow strict operating procedures when it comes to our payments. In fact, our auditors settle our batches every single day, even over weekends, just so we stay on top of things.
It sounds like you run a tight ship. Please continue those good behaviors. My other suggestion for you would be to consider pursuing different pricing terms with your acquiring bank, especially if your added costs are affecting more than 10% of your total transaction costs. Are you aware of the pricing options available?
I know what we have currently in our contract, but I'm always open to different suggestions.
From what I heard earlier, you're currently in a tiered pricing model. In most tiered pricing fee structures, the transactions you process are qualified or non-qualified transactions. Transactions qualify for the discount rates you've negotiated in your contract as long as they follow the processing rules outlined in your agreement. Any transactions outside of those rules, like a customer using a rewards card, can cause a downgrade to occur and the transaction is then non-qualified. As a result, you can expect more interchange and higher processing fees. If you're noticing that this is occurring more often than it used to, more than likely, that means your customer base and their payment needs have changed. That's something outside of any merchant's control. In this case, I would strongly urge you to consider pursuing an interchange-plus pricing model. If a transaction downgrades under your current agreement, more than likely you're paying a higher premium on both the interchange and the processing fees. The fees for different scenarios as outlined in the interchange rate schedules that are published by the card associations, can be very difficult for any merchant to follow and are never predetermined. However, your processing fees can be.
Oh, really? I've wondered if there was a way to obtain pricing to help average our processing costs. How can we do that?
Many processors and acquiring banks offer a solution called interchange-plus pricing. In this model, the processor simply charges an extra surcharge on every transaction along with the interchange fee. When a transaction incurs higher interchange, the processing fee remains stable instead of increasing with the interchange, as it does in the tiered pricing model. Regardless of whether the transaction is qualified or non-qualified, this protects the merchant from a tremendous hike in fees on any one particular transaction. In other words, rather than paying the most advantageous rate on qualified transactions and really feeling the burden of non-qualified transactions, you simply pay the interchange and a stable fee for processing all transactions. In the end, you have a better chance of reducing your overall processing costs.
Great. That sounds like it might just help level off our costs. I appreciate the help.
Roger, we're glad we could help. Next, we have an email from a new retail merchant who has another question for us about payments. This email is from Jack at the Electronics Mart in Miami, Florida. Jack has this to say. In my experience, it's more likely that retail stores get chargebacks and refunds, especially if we sell something online. What advice can you give us about how processors deal with refunds and chargebacks, and what we should expect in terms of fees? Zach, what do you think?
Chargebacks and refunds can affect your total annual processing costs and typically occur because a customer disputes a charge on their statement. The best way to avoid a chargeback is to follow the best operational procedures possible. You could also make sure that the billing descriptor that displays on customer statements clearly indicate your company name and phone number for questions. Likewise, make sure that your settlement amounts are the same as what you authorized for each transaction. When you process a refund, be aware that the cardholder's bank does refund the interchange. Reconcile your statements to make sure you receive those funds back into your account. Also, be certain to issue the refund from the original transaction, because if you process a refund as a separate transaction, you run the risk of not being able to recoup the fees that are owed to you.
Thanks so much, Zach. And thanks to our merchants for their valuable questions. That concludes our fourth and final video in this introductory payments education series. Following these webcasts, MerchantLink will host a couple of live webinars where we will explain more best practices you can follow right at your merchant location, along with a live question and answer session. During the Q&A portion, you may ask specific questions about the payments players, transaction fees, merchant services pricing, and more. Please be aware that we will host different webinars for different types of merchants because practices can vary greatly between types. From all of us here at MerchantLink, thank you again for joining us.